Okay, so we're getting ready to do financial accounting, chapter 10 coursework. Chapter 10 coursework. I'll have to look and see who else just came in to Zoom here in a minute. Okay. Oh, that's you. Okay, good. Thanks for telling me. All right, we're going to go to the coursework. Now, we're doing liabilities. So this is going to be a lot of different liabilities as far as notes are concerned. So notes is borrowing money. Liabilities must be paid back. Okay, we just need to kind of think about that. So I am going to go to 10.2. Here we are, 10.2. Okay, so let me try to help. All right, so this is going to be an entries for a note payable. Okay, notes payable, and this is an algorithm problem. 1021 will have the same numbers, but all the rest of these are algorithms. So I wish they wouldn't have made so many with algorithms, because it just seems like we can't work with the same numbers. Okay, when you're looking at a note, there's three things you need to know about a note. A note is something is borrowed money. Okay, borrowed money. This time we are the ones borrowing the money. When you loan the money out, it's a receivable to you, and that was chapter 8. But when you borrow the money, it's a liability to you. All right. So the principal, which is also known as the face of the note. The face of the note is how much money was borrowed, right? So the word principal equals the loan amount, and sometimes it's called the face. Okay, it's good to get to know those terms. So my problem says that Bennett Enterprises issue means usually it means to sell, but in this case, it means to start a note. All right, issues a note for $396,000. Okay, so write your note amount down. Look at how long the term is. Okay, notes have a term or a timeline, and that's when it needs to be paid back. So in this case, this is a 120-day note. Okay, my interest rate is 5%. Okay, so now I'm going to teach you how to calculate the interest on any note. The interest on any note. So I'll put this in my spreadsheet here. All right, so here's kind of the formula basically, and we are going to use a 365-day year. Believe it or not, just not that long ago, we were using a 360-day year because you can divide a little easier with 360. So they've changed to 365, even though it makes it a little harder to calculate sometimes. So that's all exercises. Assume a 365-day year. Yes.
Sorry, I'm seeing the review's extra credit.
The review is going to be worth 50 points, but it's not extra. Did I put extra?
It says extra credit on there.
It does. The review?
Yeah.
For exam 2?
For exam 2 review.
Okay, I'll go back. I didn't mean for it to say
Okay,
that.
I was just curious.
No. I'll fix that. Okay, I'll fix that. So let me put that down. Okay, so I'll go back and fix that. Exam 2 review. Fix. Because I want you to get good credit, okay? And doing the review gives you half as much as the test itself. Okay, so we'll be walking you through that. Okay. So notes payable. Once again, write down your amount of your note, the term, and its interest rate. So here's how you calculate interest. Okay, interest equals principal or the face Okay, principal or the face. In fact, I'm gonna put face of the note, face of note, times your interest rate, times the term, the loan term, okay? So the thing you need to understand about interest rates is interest rates are stated annually, okay? And what that means is when you see that this shows 5% interest, that 5% interest would be if we had this loan for a full year. Everybody with me? If it was a full year, we would take the face of the note times the interest rate times 1 year. But since this is a 120-day note, we have to modify one part of this calculation, okay? So here's how it works. We're gonna put the amount of the loan, so the face of the loan is 396,000 times 5% times, and then we're gonna do a little 120 divided by 365. So just last semester, we were doing it different, but now we're doing it this way. So one more time, here's what you want to put in. You'll want to take your loan amount times your interest rate and then times 120 over 365 days. Okay, so this is going to calculate your interest. Calculate the interest. So let me put calculate interest. Face of the note times the interest rate times the loan term. And if the loan term isn't at least a year, then you're going to have to maneuver that term a little bit, okay? Like I said, if this was a 1-year note, we could just take it times 1. Okay, but since it's 120 days, always keep your time in however see how they're saying this is a 120-day note? Keep it in the increment of time that the problem gives you. Don't ever convert those days into months or years. Keep it in days, okay? So yes, 120 days is usually about 3 months. Thereabouts, okay? But we're not going to worry about months. We're going to keep it in days. So here's what I've got. I've got 396,000 times 5%. And I think I've got it right here. Nope, I haven't written it out yet. All right. 396,000 times my interest rate of 5% times, and then I'm going to take 120 divided by 365, and then I've got to put parentheses around the whole thing. So that algebra that you said you wouldn't use, here it comes. Okay, so I got $6,510 as my interest on that 120-day note that was a 5% interest. Okay, so what we're going to do is Binet Enterprises is the one that's borrowing the money. Okay, they're borrowing the money. Spectrum Industries are the ones that are loaning the money. Is everybody okay with that? So we're going to do both sides of this note, which I think is very helpful. Okay, so the borrower, okay, is now we're going to do this note for merchandise inventory, right? Merchandise inventory. So we've got that on our books in a T account, right? So we're going to put 396,000 here in merchandise inventory. We're going to record a notes payable of 396,000. Okay, so let's go ahead and put in. Okay, they just used the word inventory, not merchandise inventory. So put the amount of the note there because the amount of the note is the amount of inventory you're buying. And instead of having to pay that within 30 days, they've worked out a note payable with Spectrum so that they can take a little longer, right? When you take a little longer paying something, sometimes interest comes into the picture, and that's what's happening. So now the next question is, so once again, this note, and by the way, this note payable, I'm gonna put Spectrum Industries. So we remember who we took this note out with. Spectrum Industries. The other thing I'm gonna do to help myself a little bit is I want to put the specifics of the note right above my T account. I do that usually when I'm doing these problems. Okay, so my note is 100, it's 5%. Okay, okay, this is a interest-bearing note. You say, what does that mean? You're gonna find out here in a minute. Interest-bearing note. Interest rate is 5%. You might write yours down, and it's 120 days before we have to pay it back. Okay, there it is. I put that right above that note payable so that I can refer to that anytime that I want. Okay, so I'm going to take out this other junk and see if we can make it happen. So here is what the borrower will be doing, right? This is recording the merchandise going up and then recording the note payable as a liability. Okay, now it's going to be time to pay it. So we calculated interest. We already calculated the interest payment. So I'll put interest payment one more time. Interest payment is the face of the note times the interest rate times 1/20 divided by 365. So you know you've got to calculate what's inside the parentheses first, right? And then across, right? So here's the interest payment. Here is the note. So I'm going to add the interest payment and the note together, and that's going to be how much we have to pay back to Spectrum in 120 days. So this is going to be the full amount that we have to pay back. Okay, so I'm going to add these two numbers together. And yes. Okay. So we want to add these two numbers together, possibly. Enter. Yes. So we're going to pay them back. Okay. So I'm going to put cash here. Okay. Cash here. So when we pay this back in 120 days, and they didn't even tell us what day that we took this note out. I'm not seeing it. So I don't know what this date is, but we're going to pay back cash, right? So we're going to pay back cash so this is the cash payment of the note. It's the interest plus the face of the note. So mine is $402,510, right? And we're going to get rid of the note, right? We're going to make the note go away. So we're going to debit the notes payable account. And then when those two don't balance, we're going to record the amount of interest, which mine is $6,500, $6,510. We're going to record the amount of interest in this interest account. Okay. So once again, this is A1, this is A2. And then this is part, here's my cash account over here. Sorry about that. I've already had it. I didn't even know it. So cash is already there. So let me make this just a little bit smaller so you can see these on the board. At least I think so. I've got this note. Okay, and then I've got cash sitting over here to the right. Okay, so what we want is we want to get rid of the notes payable when we pay it off. So we determined the payoff amount is $402,510. You get rid of the face of the note. You always put the face in the notes payable, never anything different. Okay, never anything different. So then the other debit is the interest expense that we figured already of $6,510. Okay, we keep our interest separate than the note we're paying. Okay, let's see if I got it right. Oh, I didn't put my note in right. Sorry about that. So let me try that again. 396 and then 396. There, we've got it. Okay, does everybody understand this? Did you get a chance to do yours? Okay, now we're going to be the Spectrum Industries, which is the lender, right? So Spectrum allowed the borrower to Bennett borrowed the amount, basically borrowed that inventory and didn't have to pay it back right away. Okay, so now we're going to look at it from the perspective of the lender. So the lender puts this amount in of the note, right? And it is the sales. Now, I don't know what the cost is of this, so we're not putting that in here right now. We're just, so we sold Bennett. This note receivable belongs to Bennett. So I would put that name there. Okay, see if there's two T's. Yep, two T's. Okay, so when we loan the money out, we're going to create a receivable and put the credit to that receivable in sales. Now, if we would have loaned out cash, we would have credited cash, but because we are selling them inventory and we are not worrying about the cost of the inventory. So please understand that. So the receivable goes in notes receivable Bennett for $396,000. And we're going to record that as a sale. Okay. And now we are going to receive what they're going to pay us back. So 120 days has passed. So how much cash are we sending out? We are sending out to the lender $402,510. Okay, so they're going to get the cash. So we showed the cash going down from the borrower to pay it back. And then this is the lender receiving that cash in B2. And then we're going to get rid of the receivable. And then we're going to record, instead of interest expense, it's interest revenue. Okay, interest revenue. So here comes the cash. The cash for paying back off this note of $402,510. Okay, and then we're going to show the the receivable going down. So that's going to be a credit of $396,000, and then the interest revenue is the $6510. Okay, interest revenue. So one side, whoever the loaner is, they have the receivable and they have the interest revenue when it's paid off. Whoever the borrower is has the payable, and interest is an expense to them. So this is, I think, a pretty good exercise to get an idea of both sides of a note.
Can you go to the second one, please?
So you're looking at Here's the lender, right? So when
Oh,
the
okay.
opposite just happens,
Yeah,
right? You've got the buyer is the borrower, and the lender is the seller, right, of this inventory. And it's just that this lender is allowing the customer or buyer to take more time. Usually accounts payable is about 30 days, but this one has 120 days because maybe it's a pretty sizable order. And not only is the lender making a sale, but they're also earning what? Interest, just a little bit, right? For allowing them to take 120 days to pay them. And most of the time, anything beyond 30 or 60 days, there's going to be some interest involved. Okay, interest involved. Okay, this was an interest-bearing note. Here's what interest-bearing means. You take the face of the note and you put the interest on top of the amount of the note, right? When you pay it back. So this is interest-bearing. This is also known as a simple note. Simple. You simply pay the note back plus the interest. Okay, let's go to the next one then, if no one else has any other issues. Okay, so now we're ready to look at two different kinds of notes. Okay, one is called a simple note, which is what we just did. And the other one is called a discounted note. All right, so however you want to think about it. The interest is calculated the same. It's just that when the borrower gets the money, all right, so let me see if I can make this a little bigger to where we get rid of, there we go. All right, so we're on number 2, which is 10.3, and it's got a little Excel to it. Okay, we'll see. Let's go ahead and open up Excel and see what they've got. Okay, so my note for this one is $340,000. So write your principal down for the note in this one. And my term is 90 days. And my interest rate is 6%. 6%. So what we're going to do before we go any further is let's calculate as a simple non-discounted interest-bearing note, just like we did before. Let's calculate how much that interest will be. So I'm going to take 340,000 times 6% times 90 over 365. Okay, 90 over 365. Can you believe they just changed this since we taught this last? Yeah, so whatever. They're wanting us to divide everything by 365. Because in the real world, that's what you do. Because there's 365 days in a year, unless it's leap year. But we don't really worry about leap year too much. So here is my let me make this a little bit bigger so you can see it. Here is my formula. So now I'm going to calculate. So I'm going to enter this formula in Excel. Okay, once again, O equals, open parentheses, $340,000 note times 6% times, I'm going to open parentheses again. I'm going to take 90 days divided by 365, close parentheses, close parentheses. Okay, so my interest on this interest-bearing note is $5,030. Okay, $5,030 is how much the interest is. Okay, so they're wanting us to determine the amount of interest for each alternative. Okay, the amount of the interest for each alternative. So we're gonna start here. Okay, we're gonna take equals your non-discounted note times your 6% times, in parentheses, the amount of time divided by 100 divided by 365. Okay, divided by the number of days, 365. Close our parentheses. Now we need one more set of parentheses around the whole thing. At least I believe so. Here's what you've got. Okay, one more time. So we're going to start with a set of equals, a set of open parentheses. We'll go get the principal times the interest times open parentheses, take the number of days divided by 365 up here, and then close parentheses and hit enter. Okay, well, I've already tested this. So, yep, it should be $5,030. Okay, $5,030. The good news is the interest for a discounted note, you find the interest exactly the same way. Okay. Okay, there's only one little difference. So let's go through this again. So once again, here's my discounted note on my spreadsheet. Looking at 340,000, 90 days at 6%. So I'm going to key this in again, just for a repeat, because I know sometimes it takes a little bit. So 340,000 times 6% times 90 divided by 365, close parentheses, and close parentheses again. There's the formula. Now I'm going to put it in my spreadsheet. We'll go work it in theirs. Okay, equals $340,000 times 6% times open parentheses 90 divided by 365 and close parentheses. And I think I need a set of parentheses on the front end. Yep. Okay. So there it is. So same amount, right? You say, why'd you make us go through that again? Because I want you to know that whether it is a simple note or a discounted note, a non-discounted note versus a discounted note, the interest amount is the same. So let's go ahead and put it in this spreadsheet over here. Equals. Open parentheses. Okay, we've got the equal sign, last I knew. Okay, equals. Open parentheses. Go get your principal amount times your interest rate times, open parentheses again. Go get your 90 days divided by 365. Close your parentheses, close your first set of parentheses. Okay, this is going to get you the same amount. So either one, you get $5,030. Okay, $5,030. I'm going back to Cengage a minute. So no matter which alternative you have, the interest is the same. Everybody got that? Okay, you say, well, what the heck difference is it? Here's what the difference is. When you get the loan proceeds, okay, when you get the loan proceeds, where is that coming from? Okay, when you get the loan proceeds, you get a non-discounted note, you're going to get all of that cash. All right, so mine was 340,000. Okay, when I record that amount of cash coming in, because we're borrowing it from probably a financial institution, then that makes my amount of cash $340,000, right? So if it's interest bearing, here's the amount you're receiving from the lender. You're receiving the entire face of the note. Okay, the entire face of the note. However, when you get down to the discounted note, it's actually the loan proceeds minus the interest. Okay, so minus the interest. So you have to subtract, okay, when you get your loan proceeds from a discounted note, you're going to subtract the interest first. Okay, so here is what it will look like. So my loan is $340,000. Okay, I'm going to subtract my interest. Okay, and that's going to leave me with, if I've got it in here correctly, it's going to leave me with the proceeds of my note, $334,970. Okay, so I would not be able to put in the full amount of the note because this is a discount. So the cash that I'm getting from that loan is $334,970. But I'm still going to put the face of the note in the loan payable, right? And when I record this note on my books, I'm going to record the interest right away, immediately, when that note gets issued and those proceeds go to the borrower, right? So I'm getting a little less proceeds than an interest-bearing note. Okay? Discounted notes sometimes are for businesses that credit isn't so great. Their credit isn't so great. So they take the interest right off the top of those loan proceeds, right? But this is an interest-bearing note. You get the whole face to go spend money at your business. But on a discounted note, they subtract that interest from the note and give you what's left after that to go do whatever. Okay? So if you're a business trying to grow your business and you're borrowing money and you're going to pay 6%, would you rather get $340,000 to go do with what you want to, or would you rather get the discounted amount? You'd rather get the interest-bearing proceeds, because then you're going to get to go use the loan to go do whatever it is you're going to do, but you're still going to have to pay back the $340,000 plus that, okay? Plus that on top of it when you pay it back. So alternative blank, the interest-bearing or the non-discounted note is more favorable for the buyer, okay? More favorable for the buyer, okay? Because the borrower, okay, so let's see, alternative one, which is the interest-bearing note, is more favorable to the borrower because the borrower receives more cash, right? Yep. Okay. So what ends up happening, let me show you this on my sheet. What ends up happening is you're going to, the one that's using the discounted note, there's the interest, right? If you take the interest and divide by the loan proceeds that you're getting, that interest rate is actually just a smidge bit higher than 6%. Because you're only getting the discounted amount. All right, everybody okay with those? Okay. All right. Here's kind of my favorite thing to do is payroll, right? Payroll. Now, this is a good chapter for all of us because most of us get a paycheck, right? And we need to understand how paychecks work. All right, so I'm going to put this up here. And this is number what? Number 9. Okay, number 9. And I wanted to show you in a little table how net pay is calculated. Okay, we're going to learn quite a few things about payroll here. And all of the taxes that are pulled out of people's paychecks, right? So Social Security, Medicare, federal income tax, retirement savings. If you pull out money out of an employee's paycheck to send to United Way, those are called withdrawals. All those withdrawals have a liability account that goes with them. Okay, so we'll see one called Social Security payable. We'll see one called Medicare payable. We'll see one called federal employee federal income tax payable, and so forth. So all of those things that are being deducted from employee paychecks, that business is that's not their money. It's not their money, okay? So they're gonna put it in a liability and send it on to the taxing authority when it comes time. Is everybody okay with that? All right, so let's go through this. We've got 3 different employees here, a consultant, a computer programmer, and an administrator. All right, so let's go ahead and put in, let's start with the consultant. Okay, how does the consultant get paid? Okay, our consultant is paid weekly, right? Weekly. When you're paid weekly or monthly, that's a salary, right? It doesn't matter how many hours you work. That's the amount you're going to get paid. So no matter how many hours I put in here, I get paid the same amount. Okay. So you could say, well, what makes you want to work all your extra hours? Because I want to get things done for students. So sure. So let's go ahead and put in how much this salary is for this consultant. I've got $3,310 is the salary for the consultant. So a salaried person is not eligible for overtime. And in fact, it's supposed to be against the labor laws. Of course, it depends on what state you're in, so I better be careful. You're not supposed to put someone on salary just to avoid paying overtime. Yeah, that's not supposed to happen. Okay, so let's look at this first one. I've got a consultant that makes $3,310 a week. There is no overtime that applies to that person. And the federal income tax to be deducted is $925. Okay, now we're going to calculate. We're going to calculate the Social Security amount coming out of the check. And we're going to calculate the Medicare amount coming out of the check. Now, when you're dealing with payroll, you need to try to make sure that you're using numbers that goes all the way to 2 decimals to the right, because we know money stops at 2 decimals to the right. And some of these are going to start calculating like that. All right, so here's where I'm at. I'm going to take the gross pay, okay, the gross pay times, okay, and where do I have my percentages here? Just a second. I've got them somewhere here. Let me see. Okay, so the amount that is figured for Social Security is 6.2%. Social Security is here it is, it's up here. 6.2%. Let me change it. So this has changed since we did this last time. So our Social Security is calculated at 6.2% of our gross pay. Our Medicare is calculated at 1.45% of our gross, okay? So you can't subtract anything before you find out what your Social Security amount is coming out of your paycheck. So this Social Security amount is 6.2% of your gross. Your Medicare amount should be 1.45% of the gross. Okay, so it looks like I've got these. So these are all my deductions. And I'm going to add all the deductions together to come up with a total deductions or withdrawals. And now let's call them deductions, total deductions, because that's what that, right? Total deductions. So when you subtract your total deductions from your gross salary, you should get net pay, all right? So the gross pay for the consultant is just what it says there, a week. $3,310. But when we calculate the deductions and subtract them, the net pay is $2,131.79. Okay, make sure you put those 2 decimal places on the end so that, okay, so what is wrong? Sorry. Okay, something's wrong with mine. Let me see, my federal income tax is $925. My Social Security tax. Okay, let me see if it's calculating. Let me just calculate it myself right here. Times 6.20. Nope. Hang on just a minute. I put that in there wrong. My fault. So this should be 0.062. 6.2%. Okay. My Medicare tax should be the gross pay times, okay, times the 0.0145. Okay, so 48. And these add up together. Okay, and I got 2131.79. Now, more than likely, it's some kind of a rounding error, unfortunately. So let's see, what does this say? When required, round intermediate calculations. Okay, so our intermediate calculations are here. So let me see here. Nope, just to see what's going on. Okay. That's not it. Okay, so we're gonna go with that times, nope, that's my net pay. All right. Yep, my net pay should be my salary minus my deductions, but they want us to round here. This is a rounding problem. Okay. And so now what I'm looking at, determine the gross pay and the net pay. When required, round intermediate calculations and final answers to 2 decimal places. So what I'm going to do is I'm going to take this one, and I'm going to extend out the decimals because you can't see them. All right, so here's what this is doing. Okay, so this Medicare tax, if I'm reading this right, says to round the intermediate calculations. So here's our intermediate calculations. So 47.995. I'm going to put $48 in there. In fact, I'm going to put it over here. Okay, because sometimes Excel does this to you. So 205, I believe, is what we want. And 925 is what we want. So now let me add these together and see if that's what it's doing. Okay, so how about 178 being the amount? Let me see if that's what they want. So they want, I don't know why they have to do that. Now let me put in 2,132 and see if that works. $2,132. Is that what they want? No. Okay. All right. I'll come back to that one. 6.2 and Medicare tax of 1.45. So I must be. All right. I'll come back to that one. All right. Let's go to the programmer. Okay. We'll go to the programmer. Okay, he is paid by the hour. Okay, he is paid by the hour. So my programmer is making $28 an hour. Okay, so 40 times 28 gives me my regular wages of $1,120. Okay, his overtime is not time and a half, it's 2 times the regular amount, right? So he's got, and it says the programmer worked 54 hours, so he's got 14 hours of overtime beyond 40, right? Okay, and 28 times 56 is overtime wages. I got 14 times 56 is 784,000. So let me put in the gross wages and see if I'm right. Hopefully so. Okay. So I'm feeling better about gross wages. Let's go work all the gross wages first. Okay, the administrator then makes $46 an hour. And his overtime is time and a half. And the administrator worked 61 hours. So the extra is 21 hours beyond the 40. Okay, and then time and a half. So 46 times 1.5, 1.5. Okay, I'm just checking my formulas here. So it looks to me like he made both of these amounts, one in wages and one in overtime wages, for a total of $32.89. Okay, let's see if I'm right. Okay, we got the gross ones down, so that's good. Now let me see where we're at. Okay, let me see where we're at with this net pay. Because last time I did this, it worked okay. But last time we did this, we used 6% for, and I hope they changed it in the answers here, because they're saying Social Security tax is 6.2%. Okay, and that's what I think I have up here, 6.2% and 1.45%. Okay, and I've got federal income tax of $925. Federal income tax for my computer programmer is $248. And federal income tax for the administrator is $515. Okay, so now I am going to go ahead and test this out. Okay, so this should be F140. Okay, so times this times the, all right. So I'm going to see what they say for this one. And this one should be, and I put those rates in my spreadsheet right there. Okay, so let me see if, okay, so I said, so this one, I'm going to go back to what I said. Let me subtract it. Okay, so there's what I've got. Okay, there's what I've got. Determine the gross pay and the net pay for each of the 3 employees for the current pay period, assuming the normal working hours in a week are 40. When required, round intermediate calculations. Anybody get the net pay? Anybody get the net pay yet? Because I'm not getting it. Okay, I don't know if something's grading wrong. I'm going to put this in again. 2131.79. Okay, my next one is $1,510.34. And the third one is $2,522.39. Gosh darn it. I was hoping this would go real smooth, but it's not. Let's see if any of them are right. Well, the last 2 are okay. So let me see what I've done here. I'm going to go down one and see if it fusses. Okay. Oh, I went down 1 penny. 1 penny. Oh. Gosh darn it. Okay, so there it is. 1 flippin' penny. Yeah. So I did all that. I know. I know. That's okay. Story of my life. Story of my life. So it was just a rounding thing, not. Okay, I'm not real sure. Okay, so this was supposed to come out, oh, look, my Excel was not calculating very good either. So it gave me an extra penny. So I'm gonna put 21, 31, 78 right beside it. Okay, and sometimes Excel doesn't help as, it tries to help, but it didn't there. All right, anybody have any questions of how we got the net pay of any of these? I think sometimes the hardest part, of course, is all this rounding business, but to know to take the 6.2% of Social Security and Medicare times the gross before you start deducting anything. Okay? All right, let's move to 1021. I think we all are doing this one together. Thanks be to God. Okay, we're going to do what's called an installment note. Okay, let's join in. 1021, I meant it to not be an algorithm problem. So hopefully you guys have the same one I do. Here's what an installment note schedule looks like. Okay, here's what it looks like from the book. And we've replicated it here in our problem. So the first thing I would recommend is to put down how much of a loan we're talking about. So up here it says, on January 1st of year one, Bryce and Company obtained $147,750 loan. Okay, that's the loan principal. Okay, so it's $147,750. We got an interest rate of 7%. So last time I did it, it was 11%. And the term of this note is 4 years. And we have an annual payment. So they're telling us what the payment is. An annual payment. You said we only pay it one time a year. In real life, most installment payments are monthly. If we had to go through months, do you know how many lines we would have? 12 lines a year. So let's just stick with the annual payment. Okay. So we're going to rock it through this amortization schedule of an installment note. You'll find templates for this all over the internet. Okay. So we're going to prepare this table. So the first amount we're going to put in right here is the full amount of the note. So year one starts with the first, however much we're borrowing. Okay, so let's put it in. How much are we borrowing? We are borrowing $147,750. Okay. So we're also going to journalize this note. Okay. So when we journalize this note, we're going to put it in a notes payable. Let me take out all this stuff. Okay. Let me take it all out so you can see it in the T accounts here. All right. So our annual payments. Okay. So the note payment, our note payment is $43,620. Okay, put that in. We're going to also do the journal entry for the note. So we're getting cash, $147,750 in cash. And we're going to put that note in a notes payable, $147,750 in a notes payable to the Campbell Bank. Okay, so we're going to label this Campbell Bank on this note payable so we don't get it confused with anything else. Campbell Bank. There we go. All right, so let's take the note out. So we're going to get the cash, $147,750. We're going to put this on in our notes payable, and we're going to get ready to make a payment. Okay. So everybody check. their very first entry that you recorded your note. So you got the cash and you recorded it in your notes payable. Okay, here's how it's gonna go. Every payment that you make a year, this is for a car note, this is for a mortgage, this is for any kind of thing you're making an installment payment on. The feature of an installment note means you're paying the same amount every time, right? I don't know if any of you have a mortgage or if any of you have a car payment, but they assign you a certain amount to pay each month, or in this case, it's a year. In this payment is interest and paying down the principal, okay? We have to calculate the interest first. So our interest is 7%. So we're going to take 7% times the loan and put that number there. So take this times 7% and record the number right there. Okay. So if you take 147,750 times 7%, okay, how much do you get? So I've got a little spreadsheet going on here myself, and I want to put my payment in. So once again, my amount of my note, and here's how much the payment is a year, $43,620, and we want 7%. Okay, 7%, and I need to make this 7% all the way down through here. So 0.07, 0.07, not 70%. Now here's where things can get really messed up. I put in 70% as my interest. That's not true. It's 0.07. Okay, so if you get some large number that doesn't make any sense, all right, and then we're going to subtract that interest from the payment. So the first interest I've got is $10,343, and I'm going to subtract that interest from the payment to see how much of the payment is going to be paid down on the note, right? So of that $43,620, $10,343 was interest. So that means the remainder is $33,278 was paid down on the note itself. Okay, the note itself. So now I have a new carrying amount of that note. So this note over here was $147,750. I'm going to subtract $33,278 so that now I get a new carrying amount of the note of $114,473. Okay. Now let me show you that in a payment. Okay. So now let's make a payment. Now we're going to work our T accounts. Okay. Our T account, we're going to make the same payment. Okay, so the first payment we're making, what is it? $43,620. Are we using the same numbers or you guys got different ones?
Same.
We have the same numbers, but it's gonna count 33,278 wrong.
Okay, it is. Okay, let me see what I've done here. 43,000. Did I mess that up? 43,620. 43,620 minus 7% of the note. And so this is wrong. Okay, let me see what I've done here.
It's wanting us to keep up with the decimals.
Oh,
Yeah.
of course. Didn't it? Okay,
It's 77 sub 78.
there it is. There it is. Aren't
I
they?
don't know why it does that. It's very annoying.
It is annoying. I know, it is annoying, but what I need to do is look at this and see if that makes sense. Because what this should be, right? Well, anyway, but thank you for finding that. So it's Yeah, I know. All right, so this should be 77, huh? Okay,
Yeah, because the notes carried is 43, your cash paid is 620, so
mhm,
it should be the same, so.
yeah. So, okay, so my figures on my sheet aren't working right. Okay, so we'll just stick with this and we'll put it in there. Okay, so yeah. It's being a little bit cantankerous. All right, let's see, equals. This minus this. Nope. Nope, that's not what I want. Just a second. It's the payment minus the interest. Okay, so the 8 was it's because of the 7% that I'm taking here. All right, that's fine. So if you get a little wonky, go down a little bit and see what happens, right? And you're right. Yeah, it's 3 and 7 adds up to 0, not 3 and 8. That's an extra penny. Okay, an extra dollar. I think we're good now. All right, here's the new carrying amount. At least we got that right. Now you just repeat. Here's the new carrying amount, 473, 114,473. Same payment, right? Oh, and by the way, I didn't finish my entry here. Now, let me do the entry before I move on to year 2. Okay, every year you're going to pay the same, so cash is going to go down, right? It's going to go down 43,620, 43,620. And of that, and this is where you would have found your error, I think. Of that is interest expense. Okay, so I believe interest expense is $10,343. And what did we do? We decreased the note payable by 33,277. So the note payable is going down $33,277. Okay, so that should be the entry, and you can actually watch this happen, right? So here's the cash going down, the note payable. Okay, so paying down the note, right, is 33,277, and the interest for year 1 is going to go in as 10,343. Okay, sooner or later, this note is going to get paid off, but now it has a new carrying value for the next year. Okay, has a new carrying value. And that's what we use when we calculate the interest. Okay, so here comes the next year's payment. Same amount. Now we're going to take 7%. I'm going to do this on a calculator instead of Excel because it's driving me nuts. Okay, there's probably something I need to do I had this anyway, it's all right. So 114,473 times 7%. I get $8,013.11. Now, what do they say that we're supposed to do? Round the computation of the interest expense to the nearest whole dollar. All right. So we're going to round it down. I got 8,013. So we just simply want to subtract the 8,013, 43,620 minus 8013. I got 35,607. Okay, let me see if I've got that right. Okay, and now we need a new carrying amount. So the new carrying amount will subtract this decrease in the note. Look what's happened. The first year we paid the most interest, right? And we paid a certain amount on the note. The next year we're paying less interest and what? More on the note, right? So now the note should be 114,473 minus that decrease of 35,607. So now the new carrying note should be 78,866, if my calculations are correct. Okay, so, all right. Ooh-wee. Okay, let me see what's over here. All right, we've got that. Okay, I know, 43. Okay, so I need to bring I'm using my spreadsheet here. And I've got to change all these payments to be what they should be. Okay, so 43,620. And that's what, yep, okay. All right, so. We want 7% and 7% and 7%. 07. And that, I know that's where things are going astray. All right. So we've got 78. We'll just ignore my spreadsheet here. There's something I need to do to that to make it different. All right, we're going to make our next payment. 43,620 goes down in cash. So it's going to look just like this, at least on the bottom. And then we're just going to put in what our schedule says. So we're going to have interest expense of the $8,013. And we're going to pay down on our note $35,607. $35,607. So that is the second payment of the note. Now we need that new carrying value brought down to year 3, $78,866, same payment, $43,620. Okay, and now we're going to take 7% of the carrying value, 78,866 times, 7%. Right. Okay, 7%. Okay, and okay, so 78,866 times 0.07. I got 5521. 5521 if I round up. We'll see what happens. All right. So if you take 43,620 and subtract 5521, you get 38,099. Let's see if that agrees. Okay, so we have a new carrying value then of the note, 78,866 minus $38,099. Our new carrying value at the end of year 3 is 40,767, and you bring that down to year 4. Okay, let's go ahead and make our third payment. Down goes cash. Okay, and over here, I forgot to put this amount in. So year 2 was 35,607, and year 2's interest was 8,013. Now it's time to put the interest amount for year 4. So down goes cash for the full amount of the payment. Okay, and then our interest amount is 5521. $5,521, and we're paying down on our note of $38,099. There we go. And so we're going to put this in here. So we're paying down on our note $38,099, and the interest expense was $5,521. All right. Okay, I think we're about to wrap up this note. Okay, same payment again, 43,620. Now, this last one, they have calculated the interest for us. So we simply want to subtract that amount from this payment. Okay, so if you take 43,620 and subtract 2,853, you get 40,767. And the carrying amount should be what? 0, 0, 0, 0, right? Because we're over here correct? Okay, the carrying amount is 0. Okay, so let's make this final payment. So let's go to cash, 43,620. That included 40,767 down on the note, so there's no note left. Okay, and interest was 2853. Okay, and now we're gonna add down. We're gonna add down. If we add down all the payments that we made, I forgot to do this one. If we pay down, we calculate all the payments that we made, we're gonna find out we paid more than the loan amount, of course, because there's interest involved. Okay, interest involved. So once again, that last one, they did us a favor. So 2853. And it was 40,076, $40,767. Okay, so the note's gone, right? The note's gone. Every year we reported some interest expense, which shows up on your income statement for borrowing this money. And then every time we made a payment, it went down in cash. So let's go ahead and calculate. So if you take the payment that we made of 43,620 times 4, we paid in total for that note 174,480. Yep. If you add all the interest together, okay, if you add up the interest there, we get 10,000. Okay, so we're just going to add it together. I'm just using the old calculator, even though, because Excel hacked me off. So I got 26,730. If anybody gets something different, let me know. Okay, so if I take 174,480 and I subtract 26,730, hey, there's that note. Hey, we got it, right? There's the note that we paid off, which is exactly right. Here's how much we paid in total for borrowing that money, and here's the cost of borrowing that money. Did everybody see that? Stop. When you see your car payment put into a schedule like this, or your house payment put into a schedule like this, you just want to go like this. Don't look at it. Don't look at it, because you're paying a lot more than you really thought you were because of the interest. Okay. How will the annual note payment be reported on the year 1 income statement? How will the annual note payment be reported on the income statement? So the income statement is going to show interest expense. And if we go back up and look at year 1, year 1's interest expense is $10,343. Okay, so that's what they're asking you. There you have it. Okay, let's take a break. Let's take a 10-minute break, or let's go back. I'm gonna put a stop on my recording here and see if we can get through these.